The United States stock market is currently closed. As of the final bell on July 2, 2026 at 4 p.m. Eastern Time, Nuburu, Inc., trading under the ticker symbol BURU on the NYSE American, settled at a closing price of $0.1252 per share, marking a modest intraday decline of 1.57% during the regular session, while picking up a slight 2.80% in after-hours trading to sit around $0.1287. For retail investors looking at micro-cap equities on their favorite investing sites, a price point under 13 cents usually triggers immediate skepticism. But here is the critical development that the broader market has completely failed to price in yet. Nuburu is quietly attempting to flip its entire corporate identity from a struggling industrial component manufacturer into an integrated international defense and security platform. Just days ago, the company issued a comprehensive shareholder update, highlighting that its total assets have reached approximately $76.1 million, largely due to the strategic consolidation of revenue-generating entities like Liacon and Orbit, alongside a pending majority acquisition of the Italian defense firm Tecne. This is not just another speculative penny stock trying to survive. It is a corporate restructuring play that could completely alter the financial profile of the organization over the next few consecutive quarters. When individuals look for investment help or manage a self-investing account through their individual brokerage, the consensus narrative around Nuburu is that it represents an extreme risk microcap entity plagued by persistent net losses and listing compliance threats. It's easy to see why this belief dominates forums on the popular Robinhood app. The stock has plummeted from a 52-week high of $4.24 down to its current floor near 12 cents, burning massive amounts of retail capital along the way. Investors using basic retail trading apps often assume that when a company trades at this level, it is on an irreversible slide toward bankruptcy or total delisting. However, the reality on the ground presents a starkly contrarian setup. While casual traders assume the company is running out of options, institutional observers are tracking a massive surge in trading volume, with over 16 million shares moving in a single day compared to historical averages, indicating that sophisticated participants are actively positioning themselves around the company's compliance updates and its newly announced defense pipelines. To understand why this gap between public perception and core reality exists, we have to look closely at recent trading volumes and corporate filings. For anyone executing online investing through platforms like Interactive Brokers or checking their charts on the Fidelity mobile app, the volatility in Nuburu has been nothing short of intense. The massive trading volume of late suggests that large blocks of shares are changing hands as the company fights to maintain its position on the NYSE American. On June 29, 2026, Nuburu dropped an essential update, stating that based on a preliminary financial review, its total stockholders' equity is anticipated to materially exceed the $4.0 million minimum listing requirement set by the exchange. This is massive news because it directly challenges the dominant bear thesis that the company will face an immediate, unceremonious delisting. When you look at their Fidelity brokerage account or track equity requirements on a sophisticated Interactive Brokers platform, you begin to see that management is executing a highly specific strategy to restore compliance and stabilize the balance sheet before the exchange takes disciplinary action. This ongoing tug-of-war between retail liquidations and structured accumulation is creating a unique structural environment for the stock. If you talk to anyone using a SoFi robo-advisor or managing capital through Schwab Intelligent Portfolios, they'll tell you that micro-cap asset allocation requires looking past the immediate daily noise to evaluate macro sector momentum, Right now, the specialty industrial machinery and defense sectors are experiencing significant capital inflows due to heightened geopolitical tensions across Europe and the Mediterranean. Nuburu has positioned itself right at the intersection of these pressures by shifting its capital allocation toward non-kinetic effects, directed energy applications, and software-driven defense systems. This pivot away from pure commercial manufacturing toward high-margin government defense contracts is an explicit attempt to escape the pricing pressures that traditionally ruin small-scale industrial businesses. Let us look at what this business actually does and how its underlying structure has evolved. Originally, Nuburu established itself as a developer and manufacturer of high-power, high-brightness blue laser technology. Their core intellectual property focuses on systems like the Nuburu AO150 and the Nuburu BL, which were built to produce faster, higher-quality welds for metals like copper, stainless steel, aluminum, and gold. In traditional industrial settings, standard infrared lasers struggle with reflective metals, whereas blue light energy is absorbed much more efficiently. This technological advantage was meant to give them an open runway in automotive manufacturing, aerospace assembly, and the consumer electronics space. But as many self-investing enthusiasts using the Robinhood stock trading interface have discovered, having good technology doesn't automatically translate into positive cash flow. The company struggled significantly with commercial scaling, resulting in meager historical revenues, including just over $407,000 in the first quarter of 2026, which failed to cover their structural overhead and left them with a deeply negative return on assets. Realizing that the industrial path was a slow burn that could deplete their remaining reserves, the management team pivoted towards a dual-use defense application structure. They formed a tactical alliance with SunCubes for their deep light water power platform and expanded their defense and security initiatives with a specialized laser arm initiative targeting the counter-unmanned aerial systems market. The real anchor of this transformation, however, is their pending 70% acquisition of Tecne, an Italian defense company. This transaction carries a fixed pre-money valuation of approximately 52 million euros and features a projected gross revenue target of over $336 million between 2026 and 2029. The acquisition is currently undergoing a formal review by the Italian government under its Golden Power notification rules, with an expected conclusion in early August 2026. If approved, this move will instantly transform Nuburu's consolidated income statement, giving them an established, revenue-producing industrial base with hundreds of specialized personnel in Europe. At this point, I want to hear from you directly to gauge the sentiment of the community. Comment below how many shares of Nuburu you currently hold in your portfolio, or share your thoughts on whether you think the Italian government will approve the Tecne acquisition this August. When you review this company through your individual brokerage account, whether that's via SoFi Active Investing or inside diversified Fidelity mutual funds, you must weigh the future catalysts against the inherent operational risks. The biggest immediate catalyst is the upcoming decision from the Italian authorities regarding the Golden Power review. A positive outcome clears the way for Nuburu to absorb Tecne's revenue streams and validate their entire international defense roadmap. Additionally, their laser tech business line recently advanced a $2.2 million blue laser rover opportunity through their Lyacon branch, supporting their stated goal of reaching specific 2026 revenue targets. In a best-case scenario, if the current outstanding quotations under evaluation are fully awarded, their laser-related revenue alone could hit up to $2.16 million this year, comfortably exceeding the baselines outlined in their exchange compliance plan. On the flip side, the risks here are incredibly steep and cannot be ignored by anyone engaging in serious online investment. Micro-cap companies executing major corporate turnarounds face intense execution friction. If the Italian government places severe restrictions on the Tecne transaction or blocks it entirely, Nuburu's international expansion strategy would suffer a massive setback, potentially crushing the stock price back down towards its recent 52-week lows. Furthermore, their historical financial ratios remain exceptionally weak. The company's current ratio stands at a tight 0.56, and its interest coverage ratio is deeply negative, reflecting a capital structure that is heavily reliant on continuous dilutive financing, debt conversions, or external capital injections to sustain daily operations. This brings us right back to the central psychological framework of the market, the constant tension between expectation and reality. The market's current expectation, as reflected in the depressed 13-cent share price, is that Nuburu is a failing legacy laser company that faces inevitable delisting or financial exhaustion. The unfolding reality, however, reveals a company that is aggressively using corporate restructuring, international acquisitions, and targeted defense pivots to completely rebuild its capital base and escape regulatory penalties. For investors utilizing advanced tools like the interactive brokers trading platform or setting up